quick update coming in. The latest consumer data is out, revealing it has fallen below the 4% mark, marking the lowest level since August 2019. My colleague Pallavi now joining us from the newsroom. Pallavi, what factors could be driving this sharp decline? What does it mean for market sentiment going forward? I'll hand it over to you for all of that.
Right, Sanjana, we were expecting the downward trend that we were seeing in retail inflation to continue, but this figure's actually even better than was being estimated. The Bloomberg estimate for retail inflation was at about 3.5%. The figure has actually come in at 3.34%, and like you said, this is the lowest figure we're seeing since August 2019. This does bring immense respite to the RBI and to the Monetary Policy Committee. Let's also take a quick look at some of the key internals. Consumer Food Price Index inflation has come in at 2.69%. So again, as expected, the deacceleration in inflation continues to be led by food inflation. Cereal inflation at about 5.9%. We've seen eggs in contraction at 3.16%, fruits at 16.3%, vegetables importantly contracting by 7% and pulses contracting by 2.7%. So that's some of the key internals in case of food. In case of clothing and footwear, inflation has come in at 2.6%, and in case of housing at 3.03%, while fuel and light are at 1.5%. Now, without further delay, let's quickly cut across to Madhavi Arora, lead economist at Emkay. Madhavi, thank you so much for taking time out to speak to us.
Hi, Pallavi. How are you?
Very good. So, to begin with, quick thoughts on the headline. While we were expecting a positive number, this is even better than was expected. Yeah. Is that correct?
Yes. Yes. So, yeah, I was just seeing the numbers. I think we were also around 3.55
right.
as far our focus is concerned. And I think market was also around those levels. I think the surprises come on account of a much lower vegetable inflation, and even for other protein goods as well. So pulses also, we were expecting it to be a less contractionary print than what has actually come out to be. Same is the case of vegetables. We're looking at around 5.5% YOY degrowth, which I think has sort of outdone our estimate. Same is the case with pulses, and I think to some extent egg as well. So my sense is that food inflation is the reason why your print has come out much lower than most people anticipated, including the Reserve Bank of India. So clearly, it's a good print. I think core inflation would also see some, I think, mild easing or probably a sideways move. The only reason why core inflation has been trending up in the last few months is because of gold. Ex-gold, even core inflation was a sideways story. And I think this month's print should be close to around 4.1 or 4.2 for core inflation as well. On net-net, the headline print is quite encouraging for the central bank.
I do want to ask you the outlook going forward. Now, we've recently seen the RBI MPC as well as the governor share his commentary on inflation, and the expectation is that inflation is expected to continue to remain benign in Q1. What is the expectation for the next few months? Can we expect the next print as well to be closer to what we've seen today, or do you think from here on we're likely to see an uptick going forward?
So our estimate is that we'll be somewhere close to 3.5 to 3.7 range for the next quarter, which is very positive again. And if monsoons do not turn out to be nasty, and if they are as encouraging as IMD believes, then I think the food price volatility will also be much lesser this year, which again would augur well for estimation of consumer price index. So I think for the year as a whole, we are close to around 4%, I think in line with the Reserve Bank's revised forecast. And I think there could only be a downside risk to the same, because you might see disinflationary forces coming out of this whole US-China trade mess, which essentially could be lowering the cost of commodities, and the producer prices would be the first one to get the hit, and eventually the CPI will also enjoy the benefit of that. Of course, it will come at the cost of something else for India, but the trade war mess could probably lead to a disinflationary impulse for us. Apart from that, food inflation, if taken care of with a decent monsoons and a better price volatility management, should mean that we should be, averaging the year close to 4% or even lower.
Okay, all right. So, we've seen a whole host of macro data come in the last few days. Inflation's, of course, surprised on the positive. We've seen wholesale inflation figures also come in earlier today, and that too was at a 6-month low. However, there have been some ongoing concerns regarding the revival in growth. What are you making of that right now, and what are high-frequency indicators pointing at?
Yeah, the domestic demand dynamics are not very encouraging. They're largely mixed to relatively weaker from what they were, say, 6 months ago. We have been of the view that the private economic agents in India have been, actually getting only absent. And this financial year also would largely see absence of private economic agents domestically. And of course, if at all the global trade war continues at this pace, you would see a deceleration in global growth, which could even lead to a recession. But even assuming that growth goes down by 100 bips, the RBI's own estimates suggest that India would be hit by around 30 bips on GDP. So I think the near-term indicators, as far as the domestic demand is concerned, are mixed to weak.
Okay, all right. One last question before we can let you go. In spite of the whole host of domestic developments, we cannot not talk about global developments at this stage. The last week was an interesting one, more so for the US bond markets. I'm curious to understand, given that we're talking about higher borrowing costs for American corporates, possibly for the retail side as well, are there any implications for India, and what is the expectation going forward?
See, American bonds are generally seen as the safest haven, in the set class community. They've been sold off owing to various factors, one of them being, possible, move away from U.S. bonds. So as far as the foreigners are concerned, the demand in general is sort of weak for these participants. Plus, even Fed is doing a QT. Plus, there were, a lot of technical aspects which had led to sell-off in bonds. One of those being the hedge fund arbitrage that didn't play around, and the basis trade-led crisis also had hit the U.S. bonds. To some extent, some of it is technical, some of it is structural in nature for the U.S., and it has already percolated down to, higher cost in that part of the world. Immediately doesn't impact us, but definitely how it plays around as far as Indian bond market is concerned is to see the spread between the U.S. Treasury and Indian bonds, which is also, actually on a historic low state at this point in time. But again, as I said, to a large extent, the wedge between U.S. Treasury tenure and Indian tenure, the spread that you're seeing, which is close to around 200 bips now, is not necessarily because of, anything that India is doing per se, but largely because American bonds are actually being sold off owing to various factors. And to some extent, emerging markets have also worked well to sort of improve their own domestic dynamics and have also curtailed their fiscal to some extent, for which they are also getting rewarded to some extent. So I don't think that to assume the fact that just because we are left with around 200 bps spread between UST and Indian bonds, one should actually think of a higher yield premium or term premium or risk premium that Indian bonds have to provide to foreign investors. I don't think that is the conventional way that people have been seeing it should work in this time around, because the reasons why the spread has narrowed is very different from what we've seen in the past. So to some extent, I think it may not have the same impact on Indian bonds as it used to have earlier. Even though US bonds have sold off, Indian bonds have actually rallied in the last 1 week or so. And I think there's still a merit to believe that you are going to be seeing a bull steepening bias in domestic bonds and not necessarily following American suit, because that's a very America-specific problem that we are seeing at this point in time.
All right, Madhavi, thank you so much for those insights. Always a pleasure speaking to you. Thank you so much for taking time out.